Well, good afternoon, everybody, and welcome to You Can Trade. This is Michael Burke, and I want to welcome you to a special edition of our Options Trading Event Series. Today, we have Ed Modula of the Options Industry Council, and he'll be talking about how to make your first options trade. And we'll get to Ed in just 1 minute. Keep in mind that the following presentation is for educational purposes only. All of the trading ideas and symbols discussed are for educational purposes and are not recommendations. Active trading is not suitable for everyone. Options trading carries a high degree of risk, and you can find additional disclosure information on the You Can Trade website. And although we're here to talk about options, I have to tell you about a very special event that's coming up here at You Can Trade, which is our Futures Weekend Summit. It is everything that you need to know about futures trading. There'll be lots of great sessions and great speakers, all of the You Can Trade coaches, everything that you need to get up to speed and start really taking your futures trading to that next level. And best of all, it's free to attend. So all you have to do is register. It's October 9th through the 11th. And we're going to push a link into the chat right now so that you can grab that link and register for that event. It's free to attend. And I will, and I'll push that link into the chat again here in a little while. There you go. Thanks, Nico, for pushing that into the chat. All right, so we are very fortunate today to have Ed Modula with us from the Options Industry Council. Ed is an expert in all things options and trading, and he does these outstanding events for us about once a month. So if you've missed any of Ed's presentations, you can definitely visit our YouTube channel and watch some of those previous sessions. After you watch today, I promise you'll want to go back and watch those other ones as well. So without further ado, Ed, I'm going to turn it over to you.
Thank you very much, Michael. As always, I'm happy to be here. And as Michael said, I teach options for a living. That's what I do now. I started in the business back in 1997 as a professional options market maker in Chicago. Spent some time in New York as well. Traded independently for a number of years. And now for the last 6 years, just teaching options to investors and money managers. Today's session, it's called Making Your First Options Trade. Really going to discuss the concepts and things you need to look at and consider as you're constructing that trade. We're going to talk expiration dates and strike prices and motivations. Probably a little bit in here for everybody. We'll have some basic comments and definitions and then get into some further commentary. If you're new to options, one thing I will say is that learning is a matter of repetition. That's how I learned the product. When I started in the business, we did an hour of classroom training every morning, went down to the trading floor for real live training from opening bell to closing bell, and then back up into our office for another hour of training. That was intense for the better part of a year before I ever traded an option myself. Certainly that's on the professional side. If you're an investor, you don't need that much time, but you certainly need to dedicate yourself and learn the product. Like I said, repetition is a good thing when you're learning options. That's important to keep in mind. And when you hear some concepts and you read definitions, they're not going to sink in right away. 2, 3, 4 times later, you'll be more comfortable and you'll be on your way to learning the product. Here's our disclaimer. Options are complex, not suitable for everyone, and any strategies and commentary that I offer you today are for educational and illustrative purposes only, not to be construed as an endorsement or advice. I'm going to bounce around a little bit today, starting with the basic level of calls and puts and the motivations for why you would use the product, and then we'll get into that progress of your first trade, buying versus selling. Why would you do one versus the other when it comes to calls and puts? And then what are the differences between selecting various strike prices? I'll be spending some time on moneyness. What is that and why does it matter? and then look at expirations, what's available to you when you're choosing an expiration date. Order types, order entry is going to be part of that discussion, always important. Then that last piece, I feel like a lot of investors will look at their account statement and they'll see what their executed trades are and their open positions and their overall account balance. But there's a few other pieces in there that you should also keep your eyes on to make sure that they're changing correctly. The more you know, the more confident you will be that everything is working as it should. And that should help you feel more comfortable with the trades you're making and the positions you have. First, let me start with the industry history briefly before we get into calls and puts. The listed options contract means that it's traded on an exchange. You send your orders, it goes to an exchange. Now that started in 1973. Prior to that, options had been a part of investors' portfolios for many, many decades, but they were traded in what's known as an over-the-counter fashion. One investor would call their broker and say, I am interested in trading this particular option with these details. Can you find the other side? And the broker would have to work the phone and try to find another side. If they did, a trade was executed and the buyer and seller were tied together. The exchange listed product in 1973 changed all of that and listed contracts with standardized terms. So not only do you know the stock that the option is being traded on, but 100 shares of a deliverable is a standardized term, and the aggregate strike prices, your strike price times 100 is a standardized term. When the exchanges did that, in conjunction with the clearing of options, more on clearing in just a second, it made options fungible. You could trade an option on one exchange and sell it on another, buy it on one, sell it on another. You can buy from one counterparty and sell it to another, made it fungible. Clearing means that upon that initial trade, whenever there's an executed trade, the clearinghouse, the manager of the risk management entity in the industry, steps in between the buyer and seller and severs that connection. So that's what happened in 1973. By the way, only call options traded for the first 4 years. The SEC was reluctant to offer put options right away because they were concerned about the risk associated with put options and whether or not investors would understand what they were doing. So call options only in 1973. And then in 1977, put options were listed on the board. So why are we trading options? These are not stock trades. You send your order in to buy or sell shares, that goes to the stock exchanges. Orders to buy or sell options go to the options exchanges. And why would you do that? There's a number of motivations to use the product, largely centered around reducing risk in your portfolio. You can speculate not just on bullish moves or bearish moves, but neutral moves or consolidating markets, or the possibility of speculating on a big move happening in either direction. You can do that with options as well. You can speculate on volatility changes if you have that level of sophistication. You can speculate. Generating income centers around selling options. I'll be talking about selling calls and puts today. Oftentimes, selling calls and puts are associated with risk reduction. You're accomplishing both of those, and stock acquisition, specifically selling puts. And I'm going to talk about that as well. Ultimately, it's a flexible product. That's why people use it. You can protect your portfolio, you can speculate, you can get into more market conditions than you otherwise could if you were just trading stocks. Now, one aspect of flexibility that is sometimes overlooked with options is your ability to tweak a strategy to your liking. There are classic constructions of all sorts of options strategies. Many of you who use the product already are familiar with vertical spreads, diagonal spreads, covered calls, different kinds of iron condors, all sorts of different spreads. But within that universe, an investor, when they're actually applying the use of options in a live account, can take that classic construction of a strategy and then change it and tweak it. Maybe they move the strikes a little bit differently, or they change the quantities that they're buying versus selling. Maybe they use different expiration dates. All sorts of different ways that you can change each strategy to fine tune it to be more consistent with what you want to accomplish in your portfolio. I think that's the big difference between learning options and then applying them, is that ability to take what you've learned and then use it exactly how you want it. There's two types of options. As I said, when you're sending an order in to trade an option, it goes to the options exchanges. That's where it's received. And you are either trading a call or a put option. So let's look at both of those from the buyer and seller side and the motivation of each. An equity call buyer is, first of all, paying money up front. The option premium that they pay is a cash debit right out of their account immediately, non-refundable. And the buyer now owns something. They own an equity call contract that provides them the right to buy underlying stock that is specifically 100 shares of stock. This trade is consistent with speculating and being bullish on the underlying stock. If you own the right to buy shares at a certain price, well, as that stock price moves higher and higher, the right to buy at that fixed price should hopefully gain value. That's what this investor is trying to capitalize on, a bullish move in the stock after they purchase their option. So the value of what they own increases and they can sell it for a higher value later in time. Now, options are a naturally decaying asset. I'm going to get into more detail here. I will talk about pricing models and time decay in this session, but for now, we'll just say options have a portion of their premium that naturally decays, and this investor who buys a call option is intending on that stock movement higher, the stock movement to be greater than the time decay that they suffer. And that's a key element to understand when you're buying options. We'll see this again when you buy puts. When you buy options, decay is working against you. In order to profit, you need the direction of the move to be correct, but also the magnitude and the timing of the move to be correct. It's not easy to buy options and make money and be profitable on a consistent basis. But if you can hit the right direction and have the timing correct, then you can see some very healthy returns on your options trades, which hopefully some of you have seen this year, possibly more than any in my career. I have heard about the popularity of buying options and specifically calls and having that work out for investors. Something we're hearing a lot more today than in the past. But that's what you're trying to do. Capitalize on that movement to a greater extent than you're giving up in time decay. An equity call seller is receiving premium. It's paid to them by the buyer. It's a cash credit immediately into their account. And in exchange for receiving that option premium, the call seller now has taken on the obligation to sell stock at the strike price of the option, and they have this obligation until expiration date. Undoubtedly, for most investors, the investor already owns the shares. That's not necessarily true. There are some investors that I do speak to who sell what we would say is an uncovered or naked call option. They don't own the shares. They sell call options, and they have what would be considered the highest risk options trade that exists, consistent with the risk of shorting stock with no upside protection. That's the naked call seller. Most investors do not fall into that category, and they own the shares already and sell a call option. The idea here, the motivation here, is to use the call option as a substitute for a limit order. If you own stock, say you bought stock in the 50s and now it's rallied and now it's in the 60s and you're feeling pretty good about it, then you're ready to start selling shares at $65. One choice you have is to set a limit order at 65 and try to get your shares filled at that level. If the stock never gets there, you may have to start moving that number down. The call seller is doing something different. They are selling a call option, perhaps with a strike price of 65. That means they get paid premium immediately and now have taken on the obligation to sell stock at 65, which is where they want to sell shares. So they're taking on an obligation that they are comfortable with, and they are getting paid to do so. Now, options trading often involves monitoring and position management, and that is perhaps the other way to look at this as far as the comparison between using a limit order. If you did use a limit order, the stock hit 65, you're filled. You're out of that trade right away. With an option, that's not the case. Usually, options are only exercised at expiration. So if the stock gets to 65 or 66 prior to expiration, there's a good chance you will not have your shares called away, and you would have to do something proactively, execute some closing transactions, possibly selling the shares, buying back the call option, and managing a way out of that position. Before I get into puts, while I'm talking about exercising and expiration, there is a myth that I always like to remind investors. Many instructors or many times I've heard throughout my career that most options expire worthless. And I've heard different numbers, 70, 80, 90% of all options that exist expire worthless. And this really is a myth in the industry. It's not actually true. Year after year, data from the Options Clearing Corporation, the OCC, has shown that about 70% of all options that are opened are closed before ever reaching expiration. Of the remaining 30%, the vast majority of those do expire worthless. And that's where that myth comes from, ignoring all of the previous closes and only focusing on that smaller subset that is actually held through expiration day. So when you look at that whole picture, most options are closed before reaching expiration, the profitability of which you really can't determine. And then that smaller piece either goes through expiring worthless or is exercised. Those are call options, motivations from the buyer and the seller. Let's look at put options. Here you have the equity put buyer, similar to calls, paying money upfront, non-refundable, now owns the right to sell shares of stock at the strike price, and they own that right until the expiration date of the contract. Now, there's two common motivations behind buying puts. One is to speculate on a bearish move in the underlying. If you own the right to sell stock at $45 and the stock moves lower and goes from 48 to 44 to 42, the right to sell shares at 45 should increase in value, and that's an opportunity to profit on prices moving lower. Most investors who are not using options and are bearish on the market have limited choices on what they can do. Fluctuating your cash position is usually what you're left with when you're a stock trader. But here with options, you can actually speculate, buy put options, and look for a bearish move. Now, again, you're buying options here, so you need the move to be lower, but also of a magnitude and within a timing where you can be profitable and overcome that time decay. The other motivation for buying puts is for protection. If shares are already owned and you are still bullish on your shares, but you are looking for what I usually call a form of buying insurance on your money. This is what buying a put option does. You own the right to sell stock at a certain price. Let's say you bought shares, they've rallied, you're in a profitable position, you're looking for more upside, you're still bullish, but you don't want to give everything back. So you purchase a put option that gives you the right to sell stock at the strike price of the option, and that sets a maximum loss, or maximizes how much you would give back. This is similar to or comparable to using a stop loss. The big advantage to using a stop loss is it doesn't cost anything. The put is going to cost something and it can be expensive. Stop losses don't cost anything and they don't expire. Put options are going to expire. So at some point, if you want to continue buying protection, you got to buy another put option. So two really big reasons why stop losses might be used. No cost, no expiration. The benefits of the put, first of all, is it works 24/7. Overnight protection, over the weekend protection. There have been occasions in the market's history where there has been something that has happened over the weekend and we open up Monday morning much, much lower. Your put option is protecting you all the time because you own the right to sell stock at the strike price until expiration. Also, the put option will not get you out of the position just because the strike price is reached. A stop loss would trigger at that level, you'd be out of the trade. Doesn't happen that way with a put. You own the put till expiration. You're likely not going to exercise it early. There's no need to. So if the stock drops below your strike price, you can just simply hold the option, see what happens. Don't panic. Can't get any worse. Maybe the stock finds some support and bounces back. You can also sell the put possibly and take a profit on the option itself, and then just continue to own the stock if you get more confident in that bullish outlook. A couple differences there between using a stop loss and buying a put for protection, but two different common motivations for buying puts. And then selling puts, this was the stock acquisition strategy, very popular with investors. An equity put seller is paid cash up front, non-refundable, and now has taken on the obligation to buy underlying shares of stock at the strike price, and they're obligated to do this at any time at the buyer's discretion until expiration, generating income while possibly waiting for a share price drop. Perhaps the most classic description here is you are bullish on the stock and the level is just a little bit too high. The share price a little bit more inflated than you're comfortable with. And I'm going to compare this again to being a stock trader. If you are looking for a pullback in the market, you could put in a limit order to buy at a lower level, 1, 2, or 3% below its current level. If the stock never gets there, you never make the trade. The put seller is doing something similar, selling a put option, perhaps at a strike price 1, 2, or 3% lower, and obligating themselves to buy shares at a price that they are comfortable with. In the meantime, they are getting paid option premium. If the stock never drops, they will still profit something. They have the option premium in their favor. And like all of these other strategies, when I'm comparing those two, there are differences, and you do have to manage the options position as like the others. If the stock does retreat, a limit order will get triggered as soon as that price is realized. A put option won't be. You are likely not going to be assigned. Again, we're selling options. We don't have the right to do anything. We have the obligation to buy. You are likely not going to be assigned or obligated to buy anything unless the stock is below the strike at expiration, because the buyer doesn't have motivation to exercise early, and they really don't. If the buyer wants to get out of the trade entirely, they can just sell the option. They don't need to exercise to do that. And if they want to continue with the move that they had forecasted, they don't need to exercise either. They can just hold the option. So generally speaking, there is not motivation to exercise early. The only time you are possibly going to see that is with call options just prior to an ex-dividend date. You might want to make sure if you're trading calls on an option that pays a dividend that you're aware of that. How much is the dividend? When is the ex-dividend date? It's really the only circumstance you come across early exercise is for those call options before ex-dividend date. So there's really all four sides: buying calls and selling calls, and then buying puts and selling puts. The entire universe of options strategies comes from these four sides. And you can put them together in any way you want. And some strategies involve stock and some do not. So now you've got your motivations, you know what you can do. Let's talk a little bit about choosing strike and expiration. I'm not going to say any rules here, but just things you need to think about and how you might come to a certain conclusion. Oftentimes I get asked this question. I think investors may think that this part of the process, as you're progressing along towards executing that first trade, it's not as complicated as investors might think it is. Now, I have to start my discussion on choosing strike by making sure everybody knows what moneyness is and defining moneyness. So a little bit on options pricing here. In, at, or out of the money. That's what moneyness is referring to. It's an effort to characterize where does this option sit when comparing the strike price to the stock price. An option premium is quoted on a per share basis. So any premium you see in the options chain is quoted on a per share basis. I had already stated that a standard option delivers 100 shares. So an option premium is quoted, say, whatever you see times 100. That's the actual dollar amount. And it has two components to the premium. The first one is intrinsic value, which attempts to look at the strike price versus the share price and the difference between the two. Now, a little more on that in a second, but looking at strike and stock price, and I'm going to say this over and over again. Intrinsic value compares strike to stock. Extrinsic value is the time value portion that is comprised of a number of variables, including days to expiration, implied volatility, dividends, interest rates. Now, dividends and interest rates are usually known numbers that don't change too often, and when they do, they can be forecasted. Days to expiration, everybody knows how many days there are till expiration, and it changes from one day to the next. Implied volatility is always changing, even throughout the day. Extrinsic value is made up of all of these pieces, and it is this part of the option premium that decays as expiration approaches. The intrinsic value does not decay. And sometimes when people learn options and they hear this decaying asset and that options drift towards zero at expiration, they think the higher premium they see, the more opportunity there is to make money by selling that option because of time decay. That's not really true. If you sell a higher priced option, you might have combined intrinsic and extrinsic value together. Intrinsic value is going to be sensitive to stock price movements. Extrinsic value is going to be sensitive to days to expiration, which are always declining, and implied volatility, which can move up or down. In the money options are options that have inherent value, or they have intrinsic value. For call options, these are options that have a strike price below where the stock currently is. The way I describe moneyness is if the option holder owns the right to execute a transaction in shares of stock at a better price than the open market is giving, then the option is in the money. That's what ITM is, in the money. If it is in the money, then it will have intrinsic value, calculated as the difference between the strike and the share price. Now, it may also have extrinsic value, but at the money or out of the money options, all of those other strike prices will have zero intrinsic value. All of the premium you see will be extrinsic or time. This will decay and head towards zero as expiration approaches. Another way to look at this, you have in the money, at the money, out of the money for call options. If you own the call option and your strike price gives you the opportunity to buy at a better price than where the stock currently is, it's in the money. If you own the right to buy shares at a worse price or higher, it's out of the money. And by definition, at the money is when those two levels equal each other. In practice, at the money options are generally referred to strike prices that are very close to where the stock is, not necessarily equal. And for put options, same definition from the opposite side. If you own the right, if the put holder owns the right to sell shares at a better price, higher price than where the stock currently is, then it's an in the money option, and you would expect it to have that inherent value. That in the money intrinsic amount is the very least you would expect this option to be trading for or valued at. An out of the money option for puts is when the strike is below the stock. You own the right to sell shares at a lower price or a worse price than you can get in the open market. There's no inherent value. There's no intrinsic value. Any premium associated with these out of the money options on either side here is just to account for the potential that the stock moves and the option gains value. Now, don't confuse moneyness with profit. Whether or not an option is in or out of the money is not directly related to profit. Profit is simply the difference between what did you buy this option for, what did you sell it for. That's all profit is. If you buy an out of the money option, of course, you want it to become an at the money and then in the money option. You want that transition to take place, and that'll work in your favor. But profit is simply buy the premium bought versus the premium sold. And this moneyness concept used to determine the intrinsic value. And again, one of the key takeaways here, stock price movements are what influence intrinsic value. Intrinsic value does not decay. All out of the money, at the money options have zero intrinsic, and all of that value decays. You want to know that when you're buying or selling options and when you're selecting strikes. Is there any intrinsic value? If so, how much? And then you know that amount is going to be sensitive to the stock moving. The rest of the premium is going to be sensitive to time passage and changes in volatility. A little more on moneyness now as you're selecting strikes for various strategies. And let's just look at the most simple strategy to begin with. You're buying call options. So which strike are you looking for? Well, in the money options, of course, are going to cost more. The premium is going to cost more because you have this combination of intrinsic value and time value. Out of the money options don't have that. So intrinsic plus extrinsic is going to lead to higher premiums. The greater likelihood of the contract expiring with value at expiration. Of course, that follows. That's common sense. This call buyer of an in the money option will have a lower break even or a better break even point. That means in exchange for spending more money up front, they have a greater likelihood of being profitable on the trade. They don't need the stock to move as far in order to be profitable. So even though they're spending more money on the trade, when you look at the risk profile, you could make a case that this call buyer choosing an in-the-money strike is actually being more conservative because they don't need as much of a move in the stock in order to be profitable. Out of the money strikes have, of course, lower premium. There is only extrinsic or time value that they need to be concerned about. And as the strikes move farther and farther away from where the stock currently is, the premiums get lower and lower. So a lot less money is spent up front. That means in exchange for that lower cost, a much higher break-even point for the call buyer. In that regard, it's more aggressive. A much larger move is required for the call buyer of an out-of-the-money option to be profitable. However, if they are profitable, the return on their investment would be expected to be much, much greater. That's where you might see some options traders or advisors, when they showcase some of their best trades, the returns are enormous in percentage terms. And that makes sense because the cost is so low to get in. And you can certainly enjoy that. Now, you're also comparing in the money. I just described it really looking at one for one. You're looking at buying one option. Is it going to be in the money or out of the money? If you're going to spend money on an in the money option, it's going to cost you more. It's more out of pocket, and it's a little more conservative because you don't need that big a move. If you go out of the money, you're going to save some. You don't have to spend as much, a much lower cost, but you do need a bigger move. You need that direction, the magnitude, and the timing to really line up for you in order to be profitable, and then you can get those big returns. Of course, if you have a certain amount of money you want to spend on a trade, if you were looking at a comparison between the two, you would then further have to incorporate, well, if I could buy one of these or I can buy 2, 3, or 4 of these, that's a different analysis. And oftentimes that is what investors are looking at for the added cost. Is it worth that better break-even point, that more, say, higher likelihood of being profitable on the trade? Is that worth it? Or because I can buy 2, 3, or 4, do I want to get aggressive? And the word of caution I use here is It's easy to want to be aggressive, but you have to be careful not to do that just in case it works out. The motivation for doing the out of the money option and buying more of them because they're cheaper shouldn't be that you're hopeful just in case it works out. There really should be a true belief that this particular stock is going to move in a big way, and that should be your motivation. When I compare different ways to implement strategies and different ways to make decisions like this one, choosing strikes, I'll often say every trade is different. I wouldn't come across and say, well, you should buy in the money strikes or you should be buying out of the money strikes. Every trade is different. Your confidence level is different. Your risk tolerance is different. Analyze the current environment and make the right choice. This is going to cost more and be more conservative. This will cost less. Maybe you can buy more, but you need a bigger move, more aggressive. And that's some things to think about when selecting strike. Now, with any different strategies, there's all sorts of different ways to look at it. Covered calls that I mentioned earlier, you own stock, you're selling a call option. It's a bit different there. You're selling options in that case, and the lower premium you get, the more opportunity you have to make money because that stock could be moving in your favor. That would be a discussion for a covered call presentation, but the point is that different strategies may offer a little bit different ways for you to look at selecting your strikes. Expiration selection, I first want to describe the availability of certain expirations. For the most popular symbols that exist, investors are looking at weeklies, months, and leaps all being available. And if you're trading the biggest names, you may not even be aware that exchanges make decisions first of all on what symbols are going to get options, because some don't even get options. They don't trade enough. There's not enough volume. The exchanges don't think there's going to be a whole lot of interest in options, and they've got criteria they look at. An underlying stock needs to be trading at least $3 a share. It needs to be trading on a national exchange. There's a volume in the stock that the exchanges look at. And then they decide what stocks are going to get options. If that decision is made to list options, then monthlies will exist. But the decision to list weeklies and leaps around the monthlies is another decision the exchanges make for those options that trade more frequently, or for underlying stocks or ETFs that have high volume. They're the ones that get weeklies and leaps. There's a whole lot more weeklies and leaps available today than there used to be. So some of you might not even be familiar with that decision process that goes across the board here, and that monthlies really are different from weeklies and leaps. Remember, monthlies are the third Friday of the month, and weeklies are all of the weekly expirations that go around that. And usually they go out up to 5 weeks, and then the leaps go out longer term, up to about 2.5 years. But they're all looked at a little differently, and you might see strike prices that aren't consistent across the three because they really are looked at differently by the exchanges. When you're selecting your strike, you have to remember your forecasts, and price and premium, the cost you're paying or the premium you're receiving is going to play a role here, but your forecast is often your driving decision. Where is the stock going to go? How long is it going to take to get there? And what kind of risk tolerance do I have? When it comes to buying options, you want to keep your costs relatively low as you can. That gives yourself a good chance to be profitable, but you need that option to move further in the money, or you need that out of the money option to become an in the money option. You need enough time for that to happen. If you think that move is going to happen right away, then you can choose a weekly. If you think that move is going to take some time, you might look out further than that. When it comes to selling options, generally speaking, the strike is selected to be the level that the investor believes the stock is going to get to, but is not going to breach through. It's not going to get through that level. That is generally a starting point for selecting your strike when you're selling options. Where's the stock going to go, but not go beyond? And then again, how long is that going to take to happen? What is my fundamental or technical analysis telling me? And then you can select your expiration from there. Now, time decay and the rate of decay is a big consideration here, and that's what I want to talk about next. The rate of time decay. And here you see it for in the money and out of the money options who have very little time value. It's really it's a linear rate of decay because there's not much time value there, and it just slowly, gradually decays over time. But an at the money option, that's where all the action is, a lot of the volume is, has this non-linear rate of decay where this tipping point of decay where it really starts to accelerate is about 40 days out, roughly 40 days out. That's where this starts to occur. And it increases all the way through expiration. The fastest rate of decay is going to be here at expiration, but also the lower premium amounts are here close to expiration. So when you're buying options, you don't want to suffer fast time decay, but you also don't want to pay a lot. You can pay very little, even close to this curve, and maybe profit if the move is quick enough. When you're selling options, you want as fast a rate of decay as you can get, but you also need enough premium there. So you might need to go out a few weeks. But again, that 40 days is a tipping point. And when you go beyond that, you have very slow decay. Option buyers might like this. Option sellers would not. When you go out much further in time, it's more common to see option buyers go out further in time to give their stock enough time to move. Less common to see option sellers go out that far because of that slow decay. I want to talk about order types, a little bit about order entry as well. And this is not going to be too complicated and will look similar to buying stock. When you're trading shares, you're either buying or selling them. With options, it's a little bit different. You can either buy to open or buy to close, sell to open, sell to close. These are the 4 trades you can make when you are opening a new position or you're adding to an existing position. That is considered an opening transaction. The first trade you're making on this option, are you buying it or are you selling it? That's an opening transaction. So buy to open is a purchase transaction to create a new or add to a long options position. The other opening transaction is here. Selling to open is a sale to open or create a new short position or add to an existing short position. Those are both opening transactions. And then if you were to close either one of those positions, you would then enter the opposite close. So after buying to open, your closing transaction would be selling it to close. And following a sell to open, you would then follow that up with buy to close to exit. There's different order types. And that goes along with the choice of using a market order or a limit order. Market orders are simply buy or sell orders that are going to get filled at the best available price. This is an order that is very aggressive and sometimes is used when investors are panicking and they absolutely they have to get out of their trade and they don't care what price it's going to be at. They're just going to buy or sell it, whatever the market gives them. Limit orders can be as aggressive as you want them to be. This is an order where you buy or sell at a specific price and you identify what that price is going to be. Just looking at our examples, I wanted to outline different ways to be aggressive with a limit order. Let's just look at this XYZ, strike price 311 call option. It's just looking at the midpoint, and here you have your bid 452 and your ask 457. Let's say you were interested in selling this options contract. It's going to be useful to look at the bid, the ask, and it's nice to see where that midpoint is. This might be your starting point, 454, maybe 455. You're interested in selling, but you're not going to be too aggressive. Maybe the stock fluctuates around this level, and if it drifts higher a little bit, maybe I can get filled here at 454. We'll see what happens. It's a moderate level of aggression. You can go the other way if you think the value of this option might increase, and you're not interested in selling quite at this level. But if it goes higher, I'll go ahead and sell it. So you could put in a limit order to sell at 457 or even higher, 460, 465. Your level of aggression is going to determine where you want to go. That the higher you go, the less aggressive you are being. Where I really want to focus is on the bid side. If you want to be more aggressive and go right at this bid and sell at 452, you may or may not get all of your contracts filled at that level. There's another metric you could look at called market depth, which will show you not just 452 at 457, but how many contracts are on the bid and how many are on the ask. Is there 1 versus 1? Is there 100 versus 100? You don't really know unless you see that metric, and you can pull that up on your platform and look at it. But for those of you thinking about using a market order when you want to be aggressive, you can actually use a limit order and sell this option through the bid. Say a limit order to sell this call option. And let's say we're doing a cover call. So it'd be a sell to open this call option at a limit price of say 450 or 448. You can go through the bid to be ultra aggressive, to hope you get all of your contracts filled here at 452. But if there isn't really any bids there, maybe just 1 or 2 contracts sitting there, or for whatever reason, by the time your order is received by the exchanges, it disappears, you're at least setting a limit on how bad it could get beyond 452, and you're only willing to accept, say down to 450. If you send in a market order and that 452 disappears, you really don't know. Who knows where you might get filled? You might get filled at $4. You don't know where that's going to be with a market order. A limit order at least lets you know the lowest level, or how far am I willing to let this go beyond what I see on the screen. So limit orders are very powerful, and you can really use them similar to a market order if you go through the bid and the ask. And then hopefully you get what your broker might send back to you as price improvement, because you got a better price than the order you entered. And the last segment I want to walk through today, again, as I said, investors are often looking at their statements, but they're checking that overall balance and they're checking their executed trades. There's a little more that goes on with options, which is what I want to walk through, a hypothetical of what happens in your cash account positions and then your overall account balance as you buy and sell options, just through an example. We won't make it too complicated. You're looking first here at the September 90 strike call, quoted 120 bid, 130 offer. And the trade we're going to walk through here is buying one, let me say buy to open, one September 90 call for $1.30. So now what happens across the board? Well, first of all, your cash is going to be debited by the $130. That's the premium times 100. So 130 cash decreased. Your position is now long one September 90 call. Most likely, your brokerage firm is going to value this call option at the best bid price, or the best price you can get right now if you had to sell it, and that is 120. That means the overall account balance actually went down because you paid the offer, it's valued at the bid, there's a $10 difference between the two, and your account balance went down by $10, plus any transaction fees that might be associated with it as well. I've had an investor call when they've made certain trades, especially in larger quantities, and thought, well, wait, I just made this trade 10 seconds ago. How could I be down money already? And this is that effect that you might see if you're trading an option in higher volumes or lighter bid ask than just a dime. You might notice your account balance initially change to the negative by a little bit more, just because your position is being valued at the bid or at the offer, and you executed your transaction on the other side of that. Now, some time passes, the market rallies. The quote for this option is 350 bid, 370 offer. Your cash position is still down 130. That didn't change. But now your position, this is what's changing. The value of the position you own is changing. It's now worth 350. That is the current best bid. It's gone up from 120 up to 350. And your account balance will now show positive 220. That's combining these two. Now, that would be unrealized profit, but you'd see that in your overall balance, 220. Market weakens after some more time passes, and you say, that's enough. I'm out of this trade. I'm going to sell it for $3. That is $300 that you receive in return for the option you purchased. That means your cash has now gone up by 170. The option position is gone. and your overall account balance has gone up at the end of the day by $170. I'm going to do this again from the sell side because I think maybe there's a knee-jerk answer when I ask the question to investors. If you sell an option and it expires worthless, your profit is the premium you received from that option. When do you notice that in your overall account balance? When do you see that profit? Is it at the beginning when you execute the trade? Is it at the end on expiration day? Is it somewhere in between, gradually? And oftentimes investors, maybe without thinking too quickly, they'll think, well, I'm selling an option. That means I'm getting my money right up front. So I'm going to see that profit right away in my overall account balance unless I give it back. And of course, that's not the way it works. When you're selling first, it's a little different. If you're a stock trader, you're used to buying, but you're not used to selling first. So here we have the June 35 put quoted 275 bid, 285 offer. Our example, sell one June 35 put at 275. So now what happens here? The cash goes into the account immediately. Cash goes up by $275 as we expected. The position is now short one June 35 put. We're short. The brokerage firm is likely going to value this option against us as a debit in the amount of the best offer, the best price we could pay to get this option back and close the position. That's 285. Similar to the previous example, the difference between what we sold it for and what it's being valued at is going to show up as a negative amount. The option value didn't change, the bid ask didn't change, the stock hasn't moved, but you have this slight decrease in account balance just because of that bid ask spread. Some time passes, and now you have the market for the June 35 put 155 bid at 165. The cash didn't change, still 275. That is not going to move. The position is still short one June 35 put. It's still a debit, but now that debit amount is dropping. It's a $1.65 or $165. And now we have an unrealized gain with an open position, an unrealized gain of $110. A little bit more time passes and the option expires worthless. Our cash position and our account balance have gone up by 275. So back to that original question, when you sell an option and it expires worthless, you're going to profit the premium. We did. We profited 275. That's what we sold it for. When do you notice that profit in your overall account balance? Gradually over time, specifically gradually over time as the option you're short decays towards zero. This unrealized profit and loss is going to fluctuate up and down with the option value. Eventually, if it expires worthless, you will have made that entire profit of 275. Covered quite a bit there, and then hopefully for any of you basic level getting started, there was a lot of good stuff there for you. And if there was some of you out there who trade options regularly, I hope there was some commentary to help you out as well. Everything we offer at the OIC website is free or an industry resource, nonprofit. You can find us at optionseducation.org. We have our investor services desk. Send an email to these guys. They are more than willing to help and answer your options related questions. They cannot provide advice, but they certainly can answer your questions about options from an educational perspective, or they can direct you to what we have available on our website. And with that, Michael, I don't seem to be getting my chat screen here to see if there were some good questions to pop through. So I'm going to have to turn it back to you. If there are questions, I'll be happy to answer them. Otherwise, I hope everyone enjoyed the show.
Well, thank you very much, Ed. Most of the questions were about being able to access this archive again in the future, and I have pushed that that link to the events page on You Can Trade into the chat, so you guys can all grab that right there. Again, as always, thank you very much, Ed, for another great presentation. Thanks everybody for joining us, and be sure to check out You Can Trade. Be sure to check out the You Can Trade Weekend Futures Summit. The link is in the chat if you just scroll up a little bit. And thanks for joining us, and we'll see you all at another upcoming You Can Trade event. Thank you again, Ed. Thanks, everybody. Have a great evening.